Hey, what's happening? My name is Leonard Wote, and in today's video, we are going to be discussing 3 ways you can make money investing in real estate multi-family apartment complexes. Make sure you stay tuned and make sure you smash that like button. Subscribe to this channel for more real estate videos. Let's jump into it. The 3 ways where you can make money investing in real estate apartment buildings are cash flow. Cash flow is holy grail. Equity build up and tax benefit. For the tax benefit, you have depreciation, accelerated depreciation, and a bonus depreciation. The first method is cash flow. Cash flow is holy grail as far as real estate investing is concerned. When you invest in multi-family apartment complexes, you get cash flow. So what is cash flow? Cash flow is when they receive rent, that is income from tenants, and after expenses and everything, then you get distributions. For example, you invest $100,000 or maybe $200,000 in a deal, and you might be getting 5, 6, 7, 8, 9, or 10% on your money, and that money is being distributed every month or quarterly. So that is just part of it where you make money. And guess what? Cash flow is the best money because this is something where you invest your money one time and you keep getting cash flow over and over and over again. The money works for you. So when you save money, the bank takes your money and lend it and make interest on your money. So right now you are just bypassing the bank and you are going straight into the investment and you make money straight from the property. That is one of the methods that you can make money in investing in real estate. The second method is equity build up. What is equity build up? For example, I built a house in Waldorf, Maryland, 2017 for around $400 and something thousand. Right now, the house is worth around $680,000 to $700,000. So it has already built up equity, a lot of equity in that house. So what am I saying? If I had that $400,000 in the bank in 2017, right now it's not gonna worth $700,000. It's still gonna be $400,000. So that is equity built up. And mind you, I already took out that equity from that house and invested in an apartment complex. I don't keep money in houses. I remove it, invest it in income producing asset that's going to give me cash flow every month. So that is how you have equity build up. So for example, you invest $100,000 or $200,000 in an apartment deal, and after 5 years, or maybe the term of the loan, maybe 6, 7, or 10 years, or 5 years, or even less. So maybe after 5 years, your $100,000 is going to be like maybe 160, 170, or 180, depending on the split. So how does the value of the apartment increases to build up that equity? Remember, anytime that the tenant lease comes to an end, there's always an increase in rent. Sometimes it might be flat, but there's always an increase. For example, when we bought a property for $2 million, 20 unit, and the rents are $1,000, and we bought it for $2 million. After 5 years, the rent might be $1,500, and now that property is not still going to worth $2 million. It might worth maybe $3.5 to $4 million. And guess what? We have an equity there of $1.5 to $2 million. We can take that money right now, and you that invested $200,000, you're not going to be coming out with $200,000. You're going to be coming out maybe $380 or $300, or even coming out with $400,000. So your money compounds, and you build equity on your money that you invested. And guess what? Inflation cannot wipe out your money, because inflation is going to wipe out the dollar bill, but it's not going to wipe your money because your money is inside a physical deal that is actually compounding. So that is the second method where you can make money as far as real estate is concerned. Another method is tax benefit. Oh, I love this one. Investing in real estate offers investors several tax benefits that they can minimize their loss and maximize their returns. Some of the key benefits in investing in real estate include depreciation. Depreciation is a tax deduction that allows real estate investors to deduct the cost of investment property over a period of time. So what does this mean? This means that if you invest in real estate apartment complexes, there's something which is called cost segregation. For example, you can hire a cost segregation company. They go do a cost segregation study on your property when you buy an apartment. So when you call these guys, they go there, do a cost segregation. They started writing off floors, lights, windows, and all those stuff. So they consider that those have been depreciated, and you can write them off and you can write them off for up to 27.5 years. So when you invest maybe $100,000, $200,000, or any amount, you have something that you receive every year, K1, which you can use that to write off taxes, or to. This is a huge benefit because one of the biggest expenses are taxes. You also have something called accelerated depreciation. You can accelerate this depreciation. So normally it's 27.5 years. The IRS gave that years that's the lifespan of a building. So you can accelerate it if you don't have to keep the building for 27.5 years, writing taxes every year. You can accelerate it and close it to maybe 5 or 10 years, depending on how you want to keep the property. And guess what? Then you're going to be writing off a lot every year. It's going to help you to write more. Instead of writing 30 a year, maybe you can that can be double or triple or quadruple. So you want to talk to your CPA, because CPAs, they are very good in that, and they know better. This is just an information for educational purposes. Okay, there is another one called a bonus depreciation. Bonus depreciation is a tax deduction that allow the business owner or the investors to write a huge amount of the purchase price of the deal. Like the example that I gave earlier, you bought a property for $1 million, and then they are going to deduct the land, because you don't depreciate land. The land might be $200,000 and the building is $800,000. If you divide that $800,000 by 27.5 years, that's going to be giving you like $30,000 or something right off that you're going to be writing off every year. And you can accelerate that and bring it to maybe 5 years or 6 years. Guess what? You're going to be writing off more. But like I said earlier, talk to your CPA. They are licensed in this, and this is just educational purposes. And I've gone through it, and I did a cost segregation on my building, and I wrote off a lot of money as far as tax is concerned. So these are the 3 ways that you can make money in real estate: cash flow, equity build up, and tax benefit. Make sure you smash that like button. Subscribe to this channel for more real estate videos. Let's go, baby. Boom.